Another busy morning of earnings. So we had Snowflake and Salesforce last night, in addition to NVIDIA. What stood out to you from the Salesforce and Snowflake results taken together?
Yeah, definitely a busy morning. And there's been a lot on software investors' minds in particular. I think that both of these stocks have been hit hard by the sort of negative sentiment around how AI is going to potentially disrupt the software sector. And so we saw both of their stocks after they reported earnings, despite earnings overall being good, trade down a little bit. They both since started correcting this morning. But I think that there's a divergence in how I see these two companies. And that fundamentally is because Snowflake is playing more at the infrastructure layer, where they're a company that helps other companies get their data in order to run AI workloads, whereas Salesforce is more so focused on the customer facing app. And I think that's most obviously reflected in the top line growth rate at the two. Like you mentioned, Akash, Snowflake is growing around 30% year over year. Salesforce is growing closer to 12% as of this quarter, which was actually their fastest growth rate in the last several years.
I want to ask you about how AI is affecting both these businesses differently. You kind of hinted at it here, but I'm going back to some comments that Martin Pierce wrote in his briefing newsletter last night. He wrote that Agent Force's ARR, for instance, is just about 1.7% of Salesforce's total fiscal 2027 projected revenue of about $46 billion. So, I mean, the story here, Agent Force is growing, but it's still a small part. Snowflake, like you said, it's an infrastructure layer. Maybe they're seeing a little bit more of a benefit. I mean, is the story different here?
I mean, there's some difference, but even with Snowflake, it's hard to tell exactly how much of their acceleration in revenue growth has been as a result of AI. They've disclosed the number of customers that they're seeing, and that seems to be growing really nicely. They also said this quarter at Snowflake that they signed their largest deal ever, which was around $400 million worth. And they attributed that at least partly to their AI suite. And so it seems like Snowflake is benefiting from selling AI products to customers. I thought one interesting point on Snowflake is that their free cash flow margin has actually gone from 43% a year ago to 61% in the latest quarter. So that kind of shows that even as they invest in AI, they have been able to continue to generate cash at a faster rate. I think with both Snowflake and Salesforce, however, they're huge companies. And like you pointed out, the AI product, especially at Salesforce, is a pretty small portion of their overall revenue. So even though it's growing like over 100% year over year, we still don't really know how much of a meaningful catalyst that's going to be to top line growth going forward. And I think another, important point to note is that the acquisition of Informatica for Salesforce, which closed in November 2025, was a meaningful accelerant and driver of their growth. So I think it remains to be seen, Akash, whether the organic growth for both of these companies can continue. The one negative point on Snowflake that some investors were considering is that they gave their revenue guidance for their fiscal 2027, which their fiscal year ends in January. And Snowflake essentially implied that their revenue growth would decelerate to around 27%. Now, that's still a really fast growth rate for their product revenue, which is the majority of their top line, but it's slower than it was in previous quarters. And so that could be a sign that there is something more fundamental about AI that is challenging both of these businesses in a meaningful way.
Right. Anita, I want to pivot and talk about a story that you published today on other big tech companies, bigger tech companies, even than the Salesforces and the Snowflakes. You wrote about the hyperscalers, even the Metas of the world. It's funny, we don't call Meta a hyperscaler, and yet I still seem to conflate it with it. I know it's people are going to say, don't conflate the two, and I'm not suggesting it, but it's kind of hard to talk not about Meta
Yeah.
in this conversation. Anyway, you wrote about these big tech companies and the debt that they're taking on and how it affects their credit profile. What were the questions that you went into this story with?
So I went into this story wondering about how all of these companies have issued debt in recent months. We saw two debt raises in November. We saw a debt raise more recently than that from specifically, I'm talking about Alphabet, Amazon, and Meta, which I guess one could argue if they really invest in Meta compute, maybe they will be a hyperscaler someday. But that's another conversation for another day. The question that I was really trying to answer with this piece is what will it take for these companies to actually see an increase in their cost of capital? They're issuing more and more debt. It seems like they're continuing to plow more and more capex into their AI investments. And increasingly, that's being funded in the debt markets, not just the equity markets. And so I wanted to look at what the potential impact could be of, could they get downgraded by the credit rating agencies? Are they even anywhere close to reaching that point? And are there any other factors that could meaningfully increase their cost of capital for the long term?
And so what did you ultimately find?
So the good news for investors in these big tech companies is that it looks like a credit downgrade is pretty far off. The threshold for these companies is around 1 times debt to EBITDA, and all of them by the end of 2026, at least when I talk to S&P analysts, are projected to be closer to like below zero point 0.5 times, let's say, zero point 0.2, zero point 0.3 around there. And so they have a lot more capacity. I mean, each of these companies can take on about $200 billion in incremental debt as long as they generally meet the projected EBITDA that analysts expect them to make.
And when people are calculating these credit ratings, is it only the amount of debt that they have on their balance sheet that they take into consideration? What are the other factors that they consider as they're coming up with these ratings?
Yeah, so this is actually something interesting that I learned as I was reporting out this piece was talking to these credit analysts. They're not only taking into account the credit metrics, like, can the cash flow cover the debt and then what that is going to look like going forward, but also some strategic considerations in terms of the business. So if you take all three of these companies, Meta actually has the lowest credit rating of all of them. And that is largely a function, I've been told by these credit analysts, of the fact that their business is really dependent on advertising revenue, whereas the other two companies are better diversified. And so that sort of comes with a little bit more of incremental risk. In some of my conversations, these analysts were saying that they had this downgrade threshold of 1 times leverage, but that they could even potentially revisit that if these companies show depressed cash flows in the future. And so, of all three of the companies, I would say Meta is probably, looks the riskiest right now just based on their credit rating. And that's not just a function of their current cash flow and debt situation. It is very much a function of what the future of their business could look like and how analysts are perceiving that.
Now, the other piece that you wrote about that I found interesting is you talked to these analysts about how much demand there is for this debt and the fact that these companies are, I mean, these are blue chip tech companies. And I found myself thinking about, well, clearly the demand for the debt comes from the credit rating itself, although I wondered if maybe there was a bit of a dynamic in terms of, maybe it doesn't matter what the credit rating is. If there's demand for this company at all, then the companies can just keep issuing it.
Yeah, I think that the credit rating has some bearing on the demand for the debt, but it's more like correlated than directly causation linked. And that's because, there are other factors like investors are looking at the credit rating as one measure of the financial health of these businesses, but they're also looking at a number of other factors. It's similar to like how you would evaluate an equity analyst report perhaps on a company. And I think that supply and demand dynamics are a really big factor here. Like if all these companies continue to issue more and more debt and they eventually flood the market with supply, right now we're seeing that there's a lot of demand for this hyperscaler debt. Like all these debt offerings have been oversubscribed. They've, been able to raise the amount of money that they want to raise, but it's possible that if they flood the markets with so much debt that that picture changes. And there's also the possibility that investors end up seeing the underlying credit health of these businesses quite differently from how the credit ratings agencies are seeing them. So I think there's a lot of different ways that a potential cost of capital increase on the debt side could flow through to any of these three companies. But I think credit ratings are a really big, meaningful indicator that investors are going to be looking at.
Great. Anita, I want to thank you for coming on. That is Anita Ramaswamy, our financial analysis columnist here at The Information.